The Fuel Excise Tax Podcast, Episode 4.
Greetings. Petroleum Pat here with another exciting episode in the world of excise tax. Today, we're going to catch up a little bit, cover a couple of topics that we kind of glossed over previously, and maybe explore, well, let's just let it go and see what happens. We were talking earlier about tax rates. Tax rates are pretty straightforward. It's important to remember that the basis of the taxation is the Internal Revenue Code, specifically Section 4081 is the home for all of the tax rates for the various fuels: kerosene, gasoline, aviation fuel, and kerosene used in aviation. The government, being back in the good old days prior to October 1st, or October 1st, 2005, let's back up even further. Prior to the good old days of the January 1st, 2005, aviation fuel was a defined term in the Internal Revenue Code, and it was taxed at the point of distribution, meaning that there was no tax applied on aviation fuel when it was removed from the terminal, unlike diesel fuel, and the delivery of the fuel to the airport resulted in the imposition of the tax. So what you had was the IRS regulates the people who are allowed to buy and sell fuel tax-free with various registrations. And these are commonly referred to as 637 registrations. Now, the industry, being ever clever, uses the shortcut term of "what's your 637 registration letter?" because the IRS has designated various letters as relating to the type of operation you can use. For example, if you blend fuel, meaning that you mix taxed fuel and untaxed fuel, you are a blender, and that is a 637M designation. If you are a position holder in a terminal, which we'll cover a little bit more, position holders are a S registration. Well, back in the good old days of prior to January 1st, 2005, they had a designation called the H designation. And the H designation allowed the purchase and the sale of aviation fuel to be tax-free. And it was only upon delivery into the tanks of the airport when the tax applied, and that was at the rate of 21.9 cents per gallon. So what happened on January 1st, 2001 was aviation fuel was moved from being a non-taxable fuel outside of the terminal bulk system to moving the point of taxation to be the terminal rack, and the removal from the terminal being the taxation point. So the whole point of that rambling history lesson was to point out the importance of another Internal Revenue Code section, and that is Internal Revenue Code section 4041. 4041 was a much more important code section before 1/1/2005, because at that point section 4041 has all of the provisions to tax fuel, and it's commonly referred to as the backup tax provision, because 4041 states that if tax has not been applied anywhere else in the system, you have to apply the tax here. So for example, if somehow you acquired fuel that had no tax on it, you become responsible for collecting the tax on that fuel and remitting it to the government. So that's why they call it the backup tax. It's kind of interesting to know how how that would come about in today's controlled environment. But in the good old days, back when the point of taxation was outside of the terminal bulk system, there was a much larger opportunity for tax exempt sales and the acquisition of fuel which had no tax on it, and the IRS could use that as a club upon taxpayers to say, well, nobody else paid it, and we don't care that nobody else paid it. You're the one holding the fuel at this point. You're the one who's responsible for it. It's interesting to look at the problems that prompted the IRS to force the taxation point for aviation fuel, for aviation fuel and for diesel fuel, and for all the fuels back to the refinery level. It's interesting, the growth in importance of diesel fuel, because it is kind of follows the implementation of the tax on motor fuel, because the first tax was applied. Gasoline was the first product to be taxed at the terminal, and because I assume because so much of it was used in industrial uses, in manufacturing, in construction equipment, and off-road equipment for diesel engines. Diesel engines were definitely considered more business equipment, and motor gasoline was considered much more for passenger vehicles and light trucks. So it was much more obvious that this was a taxable fuel, and so the justification for having the tax apply to everything and letting the few exempt users figure it out afterwards was much greater. So it's into this environment that you have the imposition of the tax at the terminal for kerosene and aviation fuel or kerosene used as aviation fuel back in 2005. As an interesting segue, no discussion of fuel taxes would be complete without a discussion of the Deficit Reduction Act. I can't remember the exact date, but I believe it was in the late 1990s, might have been the year 2000, when up until that point, every dime that was collected in excise tax went into either the Highway Trust Fund or the Airport and Airways Trust Fund for the specific use of paving our highways or keeping our runways functioning. And Congress, in its wisdom, decided that the deficit was just too high. We were running too much national debt. And they deemed that instead the minimum rate on fuel would be 4.3 cents per gallon. And they made that a permanent component in the excise tax, because excise taxes are designed to be flexible in that they can adjust the rate to accumulate more funds. If they have a large project, like you want to build a new set of interstate highways, they could bump up the tax temporarily to fund that, quote, temporary project, and then reduce the rates. All of the excise tax rates have a expiration clause. It's here we go again. I just love Congress. It was the summer of, it was about 2 years ago, and the date's not important unless you were in the excise tax world, but like I was saying, all of the excise tax rates have expiration dates, and they are different depending on the type of fuel. There's a different expiration rate for aviation fuel, as for aviation grade kerosene, as for aviation gasoline, as for motor gasoline, as for diesel. So Congress, in its wisdom, got into a argument with each other, and they failed to extend the tax rates, and the tax rates expired on, let's see, it was July 1st of that year. And So the statutory rate became 4.3 cents per gallon plus the 10% less tax. So you have the fuel collection rate going from 24.4 cents a gallon down to 4.4 cents a gallon, and there was no provision for recovery of previously paid tax, as is designed into the specifically planned expiration dates, and I'll cover that that whole thing at a later point. But it was just amusing because, not for those of us in the industry, it was a complete nightmare, because we didn't know what to do. Because in the past, Congress would go a day, maybe 2 days, and then they would say, "Oh, all is forgiven," and the rates really never expired 2 days ago. We're just going to pretend like they were in existence. And this was sufficient because it usually takes 2 or 3 days to bill an invoice. Well, back in the good old days, it took longer. And so if they screwed around for a day or two, everybody would kind of sit on their billing and wait to see what Congress would do and make it work. In this case, the Congress went several weeks, I think it was actually 21 days, that they let the rates expire, and then they said, "Oops, we're sorry, go back and treat it as if it never expired," which resulted in huge costs to industry. Literally millions of invoices having to be rebilled, corrected, payments of tax having to be made, refunds to customers, and or billings to customer to bill them additional tax. It was ugly and extremely difficult for the industry. But it just emphasizes the point that the tax rates are ever subject to change based on Congress's whims and expiration if they fail to act. So the key things to remember are Section 4081, Section 4041, which is the backup tax. If you're dealing with dyed fuel, you're looking at Section 4082. Section 4092 is the old code section on aviation fuel that related back to the H registration, the 637H registration. And it is out of force, but the regulations subject to it are still cited. And so that's kind of an interesting issue because they still look at the definitions that were created. So last week we were talking about the actual movement of the fuel and the terminal bulk system. Filling in a little bit, a couple of the terms that need to be addressed. I talked about a position holder. And a position holder is a concept the IRS instituted as a specific person who deals with the terminal. And this is significant because the IRS, ever looking to have more accountability of the taxpayers, requires people to maintain records. And the terminal operator, not necessarily the terminal owner, but the person who is designated as the terminal operator, is responsible for the record keeping of all of the inventories in the terminal. That means all the fuel that comes into the terminal and all the fuel that leaves the terminal.
So the terminal operator is the seller and the position holder is the buyer?
The terminal operator is just the terminal operator. The terminal operator may or may not own inventory in their own terminal. For example, there are companies, I'm trying to remember the name of the company. I want to say Magellan. Magellan has pipelines. Who's the other one? Buckeye. Buckeye is big in the Ohio Valley. Buckeye has terminals. They also have pipelines, but they operate terminals. RKA operates terminals. They don't own any fuel. They own the tanks, they own the piping, they own the metering system, but they don't actually, a lot of times they don't actually own the fuel. What they do is they rent out space to other people. So there may be 10 tanks in this terminal, a couple for gas, couple for diesel, couple for jet, couple for other products, and the terminal operator will then rent space in each tank. So I could rent space in a 10 million gallon tank. I could rent space for 1 million gallons of jet fuel. It is that rental agreement where the person is on the records of the terminal operator as being a position holder. That is important, because the position holder is liable for the tax on all fuel removed from their terminal position. Now, that didn't say that the position holder owned the fuel.
They're more like an agent or a broker, or can be?
Generally, all of the above. Generally, a position holder owns the fuel in their terminal position. So if I have 1 million gallon storage available to me in the terminal, I will usually only put my fuel into that storage. And there's a reason for this, because having subsidiary, there's nothing to prevent me as the position holder from saying, Joe, you can have an inventory of 200,000 gallons out of my 1 million gallon inventory, and I'll charge you this. The problem comes in is when Joe comes to the terminal and offloads a truckload of fuel out of his 200,000 gallons inventory. The position holder is responsible for making sure that that tax gets collected. So, yeah, Joe removes 10,000 gallons of fuel and then sails off into the sunset and never pays the tax. The terminal operator and the position holder can be both held liable for that tax. The position holder is, by definition, held liable for that tax. So the position holder has a very, very substantial financial interest in when the fuel gets removed from the terminal. So an example. Cats! God!
Let's break there. Show notes and more info can be found at the Journal of Recreational Accounting. Google knows where it is.